Partnership is when two or more people come together to run a business entity to share the profit and also share the responsibilities, which are, such as the liabilities. In this video, I'm going to discuss how to journalize an entry when partnership is formed. In this exercise, we have this man called Kevin Roach contributing his land, inventory, and 28,000 cash to a partnership. You have noticed that I have a schedule here for book value and market value. When you are doing a partnership, you only the partnership only accepts the market value. Okay, so only the market value is accepted and not the book value. Okay, but I'm going to do both. I'm going to list the book value and the market value, and then you see it, and then I hope that makes sense as I list both of them here. Okay, so we have this man contributing, and that could be a, yeah, that's a man. Okay, contributing some assets. Okay, so he's contributing this. He's contributing a land, inventory, and then a cash worth 28,000. And the land had a book value of 65,000 and a market value of 135,000. Okay, so we are going to list what he is bringing, what the book value is worth, and also what the market value is worth. Okay, so we will begin with land. Okay, so with land, what is the worth of the land? Okay, so the land had a book value of 65,000. Okay, that's what we have as a book value. And land is an asset, so it has to be on the debit side under the book value. Okay, and then, but the market value is 135,000. So we list them together, book value and market value. The next thing he brought was inventory. Okay, so we have inventory, which is worth, the inventory is worth this amount, 60,000, and the market value is 51,000. So we list both. So we list 50,000. Oh, sorry, that was 60,000. Okay, so it's 60,000. And then the market value is 51,000. Okay. And then he also brought cash, and cash is worth 28,000 right here. And we cannot have a different amount of cash from market value and book value. It's going to be the same. 28,000 cash is 28,000. So we have the same amount. Okay, what else did he bring? And we said the partnership also assume a 50,000 note payable. Okay, so he's not bringing it, but after the partnership, the company or the partnership, after they join together, the partnership says, now you are owing this amount. There is a liability on the purchase of the land, so we need to record it. Okay, but notice that when the book value, there is no liability. There's no note payable in the book value, but the partnership has agreed that 50,000 should be the liability on the land. Okay. Liability on the land that is payable, notes payable that he has to pay. So now we are going to do the journal entry for this transaction or this partnership. Okay. And remember, we are only going to use market value. Okay, whatever we did in book value is gone. Okay, so that means you are bringing your inventory. You said it's worth 60,000, but the partnership, this is what the partnership has agreed. Okay, so the market value is what the partnership has agreed. Okay, so we have agreed with this, so these are what's going to be recorded. So we're going to begin. It says provided for the partnership. I've just chosen the date for like December 31st. Okay, so and listing a chart of account, we know cash should always be the first one. Okay, so how much is our cash? Cash is 28,000 right here. So we select 28,000 and then we select inventory. So we begin with our current assets. Okay, so inventory, market value. Okay, we don't care about the book value. So we select that one and we go to land. Okay, so we have a land. How much is our land? It's a debit, so we select our land 135,000. And then we have what is notes payable. And notes payable is credit. Okay, so it's going to be on the right hand side. So credit is 50,000. Now, what is Kevin LaRoche or Kevin's capital? Kevin's capital is his total asset minus the liability to give us capital. We know the accounting equation, we have asset equals liability plus owner's equity, which in this case, the capital. Okay, so if we have the asset, we have liability, what is the capital? So the liability will move over here to become minus, okay? Minus liability will give us the capital. Okay, so that's what we're going to do. We're going to sum up all the assets, okay? And then we subtract the liability from the asset. And you notice that my total check says this one and that one is the same. So that means everything on the left-hand side is equal to everything on the right-hand side, which gives us a good feeling that we are doing something right. Let's look at a more complicated one, okay? So here we have two existing companies joining together, okay? So we have these two people. We have, let's see, I need my drawing pen. Okay. So we have Amber Moss and Latoya Pell, okay, joining together to form a partnership. Okay, combining their asset of their separate business. So they already have business that already exists, okay, and they are just joining together. Okay, so we are going to, the question is journalize the partnership to record most investment. Okay, so that's what we're going to do. So we are going to list everything that Amber is bringing. Okay, and then we list the book value of those things. And then after that, we list the market value. And we know we are going to use only the market value to record the journal entry. Okay, so let's begin to identify the assets and the abilities that Amber is bringing to the partnership, to form the partnership. We said they bring the following asset. Okay, so we have cash here for 15,000. Okay, so that's what we're going to do. We have cash for 15,000. And we know, okay, cash is always going to be the same. Cash market value doesn't change unless net present value. But in this case, we are not considering net present value, so it doesn't matter. It's going to stay the same, 15,000 for market value. Okay. And account receivable. So we have here account receivable with a face value amount. Okay, so notice the word here, face value. Okay, so face value is the same as book value. Okay, so don't be confused. Don't be confused with that. So the account receivable book value is 159,000. So we are going to record account receivable 159,000. Okay. Now we don't know the market value yet because we are not there yet. And then the allowance for for doubtful account. Okay, and we know allowance for doubtful account is a contra asset to account receivable. It's 9,700. Okay, so allowance for doubtful account is a credit, so 9,700. Okay, it's a contra asset. Okay, and merchandise inventory. Merchandise inventory right here has a with a cost of 100,000. So we were going to record merchandise inventory worth 100,000. And it's a debit, so 100,000. Okay, we listed that one there. And we have equipment, so this equipment is worth 155,000. So we record the equipment here, 155,000. And equipment is as an asset, so it's going to be debit. And accumulated depreciation, okay, accumulated depreciation is a contra asset as well, just like allowance for that for account. Okay, so that one will also be credit on the right hand side. And how much is that? That is 100,000. Okay, so we have 100,000. Okay, good. So we have all the book values listed. Now, what about the market value? So the partner market value is what the partners have agreed. So it begins here, tells you the partners agreed that 6,000 of the account receivable are completely worthless. Okay, completely worthless. So it's useless. 6,000 is useless. So we are going to record account receivable. That means we are going to reduce it by 6,000. So minus 6,000. So we take our book value minus 6,000. So this is what the partnership have agreed that account receivable is worth. Okay, so we have that one. That 11,400 is a reasonable allowance. Okay, so that means this allowance is not a reasonable one. The partnership have agreed after they sat down, we're like, no, we are not going to accept 9,700, but we will accept 11,400. So the market value for allowance for that account is 11,400. Okay, so we list that one there. Okay, and if that's for the uncollaborated remainder account, so we have that one. And merchandise inventory is to be recorded at the market value of this. So that is merchandise inventory, this one right here. Okay, that's merchandise inventory. So the company did not accept the book value, but they think the market value should be 91,450. Okay, that's what we're going to have. And now our equipment. Okay, equipment, and that equipment is to be valued 62,500. Okay, so equipment is 62,500. Okay, how about accumulated depreciation? Remember, when you are forming a partnership, accumulated depreciation is not carried over. Okay, we are going to start a new life for the equipment. Okay, so we are going to get rid of any accumulated depreciation that's attached to it. Okay, so technically, the book value of the equipment, okay, the book value of the equipment is 150, is this one minus that. Okay, so the book value of the equipment is technically 55,000. Okay, because 155 times minus 100,000 is what the book value is, but the company or the partnership has actually appraised this one. So the market value is 62,500 instead of just 5,500. Okay, so we don't carry over accumulated depreciation when we are recording partnership. We are going to give a new life to this equipment. So it's a no, you don't record it. Okay, so now let's go ahead and do the journal entry for it. So we have here the most current asset and the most active account. The most active account is cash. So we are always going to begin with cash. How much is cash? 15,000. Okay, that is a debit. And then we have account receivable. Okay, and how much is account receivable? That's the market value. Remember, don't be confused. We are only going to record what is in the market value column. Okay, so the market value is 153,000, but it has a contra asset to it. That's allowance for that for account. And what the company or partnership agreed is 11,400. Okay, and then we have merchandise inventory right here, and it's an asset, so it becomes debit. So we put it there, and then we have equipment. It's also an asset. So sorry. So merchandise inventory, we agreed with this, okay? So we only use market value. Thanks for catching that. So we have equipment. So equipment also only market value. So we select that one. And then we have, so we need to find the capital for Ambermore's investment. Okay, we need to find the capital. And remember, the capital will be everything on the left minus everything on the right. That is all the assets, okay, minus the liabilities. Okay, that's how we're going to find that. So we are going to sum up all the assets on the left, okay, and then minus the liability, which is on the right. But this, in this case, this is not a liability, but it's a contra asset to account receivable. Okay, so all the debits minus all the credits. So we will get left and right equaling to each other. Okay, so you can see left and right is equal, or left equals right. Okay. So that is how you do journal entry when two people come together, two or more people come together to form a partnership. You only use market value to record his um his or her capital. So Amber Moore's capital is 310,550. Okay. Well, there are so many ways of doing accounting, and whichever way you choose to do, keep practicing and watch my next video on how to divide net income among partners.